Hey, welcome. It's Erik Peterson, proven realty broker by EXP, and I've got a special guest today that I wanted to introduce to everybody. He's a good friend of mine, Jeff Hyatt. We happened to meet at an investing mastermind that EXP was putting on, none other than Brandon Brittingham, Wake Up to Wealth podcast. We were all down in Dallas. We ended up getting a private owner's tour of the Dallas Cowboys football stadium, and that's where I met Jeff. He was one of our keynote speakers at this investment event. We became friends and started talking all things cost segregation. Hey, Jeff, welcome, and thanks for hopping on.
Hey, thank you very much. I remember we were in the restaurant area there of the hotel and just chit-chatting, and all of a sudden we were talking about depreciation, and you didn't immediately get an ice cream headache, so that's probably a good thing, because sometimes it just bores people to death. But
yeah, I love it. I'm a numbers nerd. I spent 15 years as a financial advisor prior to getting into real estate. Now this is decade number 2, and we have used cost segregation studies. And as Brandon had brought up at EXPCon, he had asked all of the real estate agents in the room, about 400 of us, how many of you have ever heard of and done a cost segregation study? And only a few of us have ever raised their hand, and I had done several of them. And so as soon as you started talking my language, I was like, we're going to be best buddies. So I love it. So for those of people out there that may not have ever heard of a cost segregation study, super advanced IRS rule, explain that to us. Tell us about your background and exactly how it can benefit people looking to invest in real estate.
That sounds great. Thanks for the lead in there, Erik. Cost segregation. So I ask people all the time, hey, Erik, I'll talk to you as if I'm chatting with you about it. Hey, Erik, if you have an option to take a write-off today or in 27 and a half or 39 years, would you rather take it today or basically a lifetime from now?
Of course, today everybody would, right? No brainer.
I mean, the whole point of the game is reducing income taxes, because that's a bleed out for you, for your NOIs on your investment properties. If you have to give away so much of it to tax, that's a loss. That's a hole in your bucket. So what the cost seg allows you to do is, instead of writing everything off over that long, long time, you can write pieces off more quickly. So over 5 years, 7 years, or 15 years. So what the cost seg does is, per the IRS standard, identify the pieces of the building that you just bought or built or renovated, and you get to take the write-off more quickly. So you can take it in the 5, 7, 15. And at some point, we'll probably get into the big, beautiful bill and what that means. But there's some benefit to that, too. So
I love it. So most people don't know about them. How many of these have you guys done? What's your background specifically? When you guys told me the number of these studies that you've completed, it just blew my mind. Last I heard, it was over 26,000.
We're pushing 27 now that we're not through 915, 27,000. 915 being the extension of tax deadline kind of date. So 915 and 1015 are big for us, as well as 315 and 415 for the timely filers. But our firm started doing cost segs back in 96, when you were probably maybe 2 years old, Erik. But bottom line, we started doing them then, and it was an engineer and a CPA. And this young CPA guy was moving from Buffalo, New York to the Boston area to continue dating my little sister-in-law. And he said, hey, Jeff, you're consulting with small business owners. You should talk to them about cost segregation. And I said, what's that? And he goes, oh, it's faster write-offs for people who own real estate. And I said, no, that sounds boring. And I was like, no, that is not in my DNA to talk about this stuff. And he goes, no, it's really big. If your clients own real estate, they're going to be interested in this. And I said, I had to be nice, I had to be polite. I couldn't say, no, I'm not doing it, because he's dating my little sister-in-law. So, and now he's my brother-in-law for pushing 30 years. But ultimately, I talked to my clients that own Dunkin' Donuts and Domino's Pizzas and Taco Bells, and they all said, this would be amazing. And so I said, okay, let's try this. And so we were doing 5 or 10 projects a year. And then we got this big project for a company that was selling their properties to some clients of ours. It was a big defense contractor around Boston. And we saved those buyers about $4 million in income tax. And their
Jeez.
CPA said, whoa, this is amazing. You need to do a seminar for the CPAs in Massachusetts. And I said, okay. So we ended up doing the seminar. 85 CPAs attended that day, just outside of Boston. And we went from doing 5 or 10 projects a year to doing a couple of hundred. At this point, we do about 1,500 a year. We've got 37 employees, direct employees. So we have 27 people that do the site visits. They're called qualified professionals per the IRS standard. And then we have 10 accountant types who put all of their findings in the right tax buckets for the client.
So fun. So you guys are crushing it. You've got to be one of the biggest players in America in this space. I bet you that's really exciting. So back to the individual investor, or maybe a partnership. A couple of my partners, we've done them before. What types of properties benefit the most from a cost seg, or does it matter? Is it a single family thing? Is it multifamily? Is it industrial? What types of properties benefit the most?
All of those are very good candidates, meaning they're all, really, really good. So it just depends on what did you pay for the property, and what is it comprised of. So if you put me in a corner and say, Jeff, what's the reallocation percentage going to be? When I say reallocation percentage, that means how much will we be able to pull out of a property out of long life, 27 and a half, 39 years, and move it into the faster life. So I would say it's going to be between 15 and 30% can be moved into a faster life. Now, what does that mean? That means if you spend $1 million, and that's the depreciable basis, we already subbed out land. So your depreciable basis was $1 million. We can move somewhere between 150 grand and 300 grand into a faster life, which means with the big, beautiful bill and bonus, you get to take 100% of that 150K right away, or up to the 300K right away. So bam, you now have a deduction against your income, either from this property, or if you're a real estate professional, from, all of your investments. So there's all kinds of great benefits to this.
Excellent. So can you explain an example? Let's keep the number simple on just $1 million. I think most people can conceive that. The math is easy.
Yep.
So how would it work if somebody bought traditionally a building for $1 million without using a cost segregation study versus one with it and having your firm's help?
Okay, let me just do this. So if million divided by 39. So we're going with commercial property. So if you bought a building for $1 million, your straight line depreciation, as it's called, you would get to write off about 25K per year for the next 39 years. That's straight line. Okay. And so that's okay. But back to my question, Erik, when we first talked, you said you wanted to, if you could, take deductions now versus waiting 39 years. What if I said to you, hey, Erik, yeah, that's okay. You can do it that way and you'll get the same amount of depreciation ultimately. But what if I said to you, hey, Erik, you can take 200 grand today on your tax return because you're filing for 1015, let's say.
Absolutely.
So bam, why would you not? If you got 20% of that million immediately, bam, you get to take that 200 grand deduction right away, depending on what your tax bracket is. You're probably talking, 60 to $70 to $80,000 of income.
Straight to the bottom line.
Well, you get the deduction 200 grand, bam, times your tax rate. And that is what you get to keep.
Right.
So yes.
So obviously the benefits of that is none of us want to pay tax, right? We all want to limit that amount of money. But as an investor, you can take that tax savings and immediately improve the property to increase your value, increase your rents, and increase your overall return. Or you can use it to pay down debt if you're more conservative. Or as most people like to do is then get some more powder to go do some more deals and build their portfolio quicker.
You're absolutely right. So ultimately, at the end of the day, it doesn't matter what you do with the money. Most of my clients say, Jeff, I just want the money. I'd rather not send it to Washington, D.C. I'd rather keep it, and do something myself and make decisions with it. And like you just said, any one of those options, buying another property, fixing up your current property, paying down debt. Some folks, now the accountants out there have a heart attack when they do this, but they go buy a boat. And if they go buy a boat, I'd like to go fishing with them, but that's a different conversation.
Yeah, I love it. So from that standpoint, it seems too good to be true. That's what everybody always asks me. Well, if this is real, how come I've never heard about it? And specifically, why has my accountant never told me? How would you handle that scenario?
Okay. So most of my referrals come from CPAs. So the CPAs that we deal with are very real estate centric. Okay. Many CPAs and EAs out there are not real estate centric. So they're kind of like, oh, well, I'm doing 1040s. I do 300 1040s every year. And they never attend a real estate conference. They never attend any kind of webinar on depreciation because they're just looking at you as Erik, the real estate guy. He sells real estate. Yeah, that's what Erik does. But right. Over time, over the past 5 or 7 or 10 years, you've become a landlord. And you still have proven realty, but you're actually in a whole different category of real estate. And so if your accountant isn't paying attention, this is going to get missed. And the reason it's going to get missed is this started in 1996 when our firm started doing these projects. So it's relatively, in the grand scheme of tax code, relatively new, if you call almost 30 years new, but a lot of CPAs that just don't pay attention to some of this stuff. And some of them don't feel like it's their
place
job,
right,
to make sure that you're paying as little tax as possible.
Yeah, they're more preparers than they are tax planners, right? They're looking in the rearview mirror saying, hey, this is what happened to you and what your taxes are, as opposed to being a planner saying these are the strategies that you need to take advantage of now and also in the future. And so that's why it's been such a big boom for us, because we are forward thinking. My background in financial advising and then connections with great resources like you.
Well, thank you. It's a great tool. And the beauty is, if you've bought a building, built a building, or renovated a building for more than, say, $300,000, most people would consider a cost seg to be viable. And what I mean by that is, if I said to you, hey, Erik, give me $1, I'm going to do this report for you and save you $4 or $5. More than likely, you're going to say, unless you're really good at, blackjack or poker or, Texas Hold'em or whatever, unless you're really good with that, you're going to say, gosh, I'll give Hyde $1 and he's going to save me $4 or $5. Let's go. Well, once you're north of 300 grand for buying the building, building the building, or renovating it, our cost seg is going to give you at least 4 or 5 to 1. And as you go north, maybe if you're at 2.5 million, it's 10 or 15 to 1. And if you're at 5 million, maybe it's 20 to 1. And if you're at 10 million, maybe it's 40 or 50 to 1. So for every dollar you spend to get that back, and because we've got such a database, we can give you that estimate before you spend the money to do the study. You'll know roughly what you're going to save in tax. You're going to know what our fixed fee is, and life is good.
Yeah, absolutely. Anyone that would spend $1 to save 4, I mean, no brainer. But I've seen some of these studies and scenarios, and the numbers can be a lot higher. You did mention one thing that I wanted to bring back to the conversation, because cost segregation studies since 1996 have always been an incredible tool. Explain how much better that tool is now under the new provisions in the big, beautiful bill. Even more mind-blowing.
Yeah, it really is. And so without going, I could get really deep because we teach courses on this for CPAs. So I'll avoid that. And I'll just say, bottom line, if I said to you, hey, Erik, how would you like to take 10% of that $1 million over 5 years and 10% over 15 years. That's the acceleration.
Mhm.
And from 96 through 2017, people paid us to do about 15,000 studies and do just that. So people were thrilled with our work, and we were helping them move stuff into 5-year and 15-year write-off. So it's much better. And they were thrilled. And logically, you're going, okay, well, I'll divide the 100 grand by 5 and the 100 grand by 15, and I'm good to go. And you're right, you're good to go there. Well, what if I said, wait a minute, Eric, hey, there's this thing called bonus depreciation. And all of a sudden, you can use it not only for new construction, like you used to be able to, but you get to use it on a building you're buying that's already existing. Where that never applied from 96 to 17, that never applied for existing buildings. It only applied to new construction. But now with Big Beautiful Bill, you get to take the 100% immediately on anything accelerated, 5 years and 15 years. So you get to grab that all, bam, you take it, and life is very good.
Incredible. I love the strategy of that. I think that 100% bonus is going to be great and just adds more fuel to the fire.
Right.
Ironically, last night we hosted an investing in real estate event in Williston, North Dakota, where we're at, had great attendance. People were really excited. And we gave them 3 advanced strategies for building a real estate portfolio. Number 1 was cost segregation studies. Number 2 was, because of you, number 2 was 1031 exchanges and the advantages of those. And then number 3, specifically under the Big Beautiful Bill, the reason to have a real estate license and do these deals in that area. How do both cost segregation studies and 1031s work together? How are they similar, and how can they be combined to be a dynamic duo?
You asked great questions here, by the way. So the way that it works, so Erik bought a building a few years ago, and he's ready to sell it. Maybe it's, he knows, oh, the roof's going to go soon, or the HVAC is going to go, or whatever. You've decided for whatever reason you're going to move on from that particular property.
Mm-hmm.
So you're going to sell it. And you're going to do a 1031 because you don't want to pay the tax on the gain. You paid 500 grand for it. It's worth $1 million now. You don't want to pay the tax on that $500,000 gain. Okay. So you say, okay, I'm going to do a 1031. I'm going to defer that gain. So you do the 1031. Before you do the 1031, the pro tip is to do the cost seg on the building you're selling, on the relinquished property, as it's called. So you could do a cost seg on that and pull out accelerated depreciation from that. And then you do your 1031, and then you buy the next building. And assuming you're buying a building, let's say it's 3 million. So you're kind of moving up the food chain. So you've gone from this building you paid 500 grand for. Now you're buying a $3 million building. Well, you've got new depreciable basis in that building. So you can't do the cost seg on the amount you brought forward, but on the new money that you're into it for, you get to do cost seg on that. So now you've gotten accelerated depreciation out of the building you've sold. There was no recapture on that because you did the 1031. Bam, now you're doing the 1031 on the building you've acquired. Life is good. Now, the really big pro tip, and I say this joking because the really big pro tip is to keep doing that until you die.
Yeah.
Because then your kids get the step up in basis as the tax law sits now. The kids get the step up in basis and they get to grab back. There's no recapture at that point. They get to keep it all, and they get everything at the stepped up basis. So if you were to, as they say, buy the farm in 20, 30 years, and that property that you paid 3 mil for is now worth 30 mil or 10 mil or whatever the heck the number is, your kids get it at that date of death at the higher value without having to pay any tax on it.
It's incredible, isn't it? And that's a strategy that, as we talked about, when put together with the 1031 kicking the can down the road to the IRS, and then throwing cost seg on top of it to get the upfront write-offs without having to pay recapture on the depreciation, like mind-blowing, almost seems illegal. who knows if they're going to get rid of it someday, right? We've all
Right.
seen what a budget crisis looks like and everything else. But currently, those are the rules, and a phenomenal time to be an investor, specifically in hard assets like real estate.
Right. And I was talking to one of the smartest CPAs that I know, and he's more on the tech side. So he helps companies like super deluxe tech companies get public funding. And I mean, he's brilliant, but he and I have interacted over the past 20 years related to real estate. And he's referred me his clients who happen to buy real estate, but tech companies typically don't buy real estate. They're tenants. So I'm dealing with the folks that own the buildings, not so much the tenants usually. Well, I was talking to him yesterday, and he and I are getting to the point where we're starting to say, okay, maybe we're going to back it down a little bit, sometime. And he was mentioning this to me, and he said, "But Jeff, I want to talk to you about this depreciation thing, and I know you know about it." He goes, "I'm thinking about buying some properties now because," he goes, "I don't want to like cash in all the chips. I want to stay in the game somehow." And I was like, there's so many tools that the real estate and the tax code have for it. You can't go and buy stocks. If you want to buy $1 million worth of Apple, guess what? You have to have $1 million.
Sure.
And then you can buy it, right? You want to buy $1 million of Microsoft? You got to buy it, $1 million. But what if you wanted to buy $1 million worth of property? The banking system and the tax code allow you to leverage that. So you might only have to come up with 20% down, 30% down, whatever the down payment is. It's a fraction of what you're paying. And now you get to depreciate the full amount, not just what you put down. Oftentimes I'm talking to first timers that are talking to me and talking about cost seg the first time. And they say, well, I only put down 200 grand. Well, that doesn't matter. What does the HUD settlement statement say? Right. And it's a mill. Yeah. Okay, you get to take a mill as your depreciation amount. And then, in Microsoft and Apple are, of course, not likely to fall to zero, but you could buy stocks in some other companies that could potentially go to zero or very, very low. Real estate typically doesn't do that. It never goes to really, really low. It might drop in a trough 10% or 20%, but it typically doesn't go to zero.
Yeah, it's wild. I remember when I got into financial advising back in the late 90s, and one of the things that we were always asking our clients is, what did you pay for your first house? And what did you pay for your last vehicle? And usually the last vehicle was more expensive than their first house. And I just laughed about that. I said, oh, that'll never happen to me. Well, in 1999, bought my first house for 100 grand. I'm not going to pay 100 grand for a vehicle, but a lot of our clients do. And you can now buy a truck for 100,000, your drive around truck. It's crazy how much, inflation has increased the prices of everything, and how much dramatically house prices have gone up around the whole entire country, even in the sticks of North Dakota out here. So,
right. It's crazy.
So back to that. I mean, obviously the strategy is really important to get all your ducks in a row. One of the risks is going to be there's some online companies that will allow you to do a cost segregation study for you that don't have 27,000 of these under their belt, that haven't been doing them since the 90s, that could set you up for failure and not do the study correctly. One of the advices that I would give everybody is to make sure that you have a legitimate company that specializes in this, that sends out an engineer to physically walk the property, in case, just like in an audit scenario, 4 or 5 years down the road, the IRS comes knocking on the door and you've been trying to keep them at bay. Now, all of a sudden they show up and you don't have a way to defend yourself. Please talk to the importance about why to hire you guys specifically versus another option that you might be able to find online.
Oh my goodness. So we were doing cost segs, to put it in perspective, before there was social media. Okay. Right. That's what's absolutely bananas. But now you almost, by listening to this podcast with Erik here, more than likely your social media feed, because good old Bill Gates is listening in, and so is Mark Zuckerberg, and they're going to start flooding your social media feeds with cost seg stuff. And you're going to see names like remote cost seg or do-it-yourself cost seg or non-physical site visit or virtual site visit cost seg. And the IRS specifically says in their audit techniques guide, so in their way of communicating to their field agents, who are the people that do the auditing, their audit techniques guide says you must have a qualified professional do the site visit. You can't just wing it. You can't just do a remote site visit. And what many of my competitors, most of my competitors say in their engagement letters, but nobody reads the engagement letter. They just go, oh yeah, that looks good. I'll sign up for that because it's cheap and easy. Well, it says they're going to do a remote site visit, a virtual site visit. The latest one I've seen is non-physical, which, I was like, what is that's remote. And the tax code says you can't do it. So what will happen is, and so to just keep it on the example of you, Erik, you hit send on your tax return, or your accountant does, bam, send. It's not like it goes in and bam, 15 minutes later, you get an audit notice. So that's not going to happen. It's going to be a couple of years, if not 3 or 4 years, before you actually get the audit notice. And guess what? All that time has been, this tax, and for the IRS's perspective, it's been accruing, penalties and interest. And now you're going to have to pay them if they disallow your deduction. So why would anybody in their right mind go ahead and do a cost seg that could get blown out of the water upon audit and then be subjected to penalties, interest, tax, and compound interest at that? There's another factor that we always provide, and my competitors out there, if you actually, again, read the engagement letter, it says, my competitors would go, oh yeah, we've got free audit support too. Yeah, we got that. Well, the deal is, if you read the engagement letter, it says they provide free audit support to the field agent. And the field agent's the first person in the door. And she's going to say, Erik, hey, you've got a huge deduction here. What's going on? And you're going to say, oh, we did a cost seg. And then bam, she's going to say, oh, can you send it? Which you will. And then she's going to say, thank you for sending this. We're going to have the IRS engineers get back to you with any questions. And there went your free audit support, because now you're outside of the scope of their contract, and you're going to be on the hook for $300 to $600 an hour for audit support. We don't play that game. We do real free audit support, period, end of sentence.
Great. So if somebody's interested in learning more, that wants to save money on their taxes, tell them about being able to go back, even if you bought this property 5, 10, 15 years ago. Tell them about the process and the benefits of doing it on a previously owned property, and then also speak to the need to do it on all properties today and moving forward.
You asked the best questions, I got to tell you. So thank you. So yes, so even if you didn't do it in the past, some people get bummed out. Oh, I should have done this on that building I bought 5 years ago or 10 years ago. My accountant didn't tell me about it. Whatever it is, bottom line is you can go back in time without amending your tax return. Again, many accountants don't know this. So you use what they call a change in accounting method form. That's too much detail probably, but the bottom line is you don't have to amend. You can step back. And what you're saying to the IRS is, hey, listen, to use our $1 million example we're running with. Hey, listen, I've taken 40 grand of depreciation so far. I could have taken 200 grand. I'm going to step back and grab that now. And it applies to the current tax year. So you get to take that 200 grand retroactively in the current year against your income from this year. So it could have been a strategy not to do it a few years ago because maybe you were in a low tax bracket then. But regardless, you don't have to amend. You get to do that. And on a go-forward basis, when you buy a property, what most people really like is with our reports, again, because we are the tax dork in the room, what our reports do is identify every single thing in the building, not just the 5-year, not just the 15, but also the stuff that is not accelerated. And that's important because, Erik, that building you're buying, you know what? You don't know it yet, but in 5 years, that 39-year roof is going to fail. And you're going to have to take it off the building, put it in a dumpster. You're going to have to spend a bunch of new money on that roof. And while there will only be one roof on your building, there's going to be two roofs on your depreciation schedule. The one that came with the building that you initially bought, and then the one that you had to pay to put on. And that's tax inefficient and not required. So what our studies do is allow you to have another bite at the tax apple in that 5 years. When you go to rip that old roof off, you get to take a deduction on the abandonment of that original roof.
Who would have ever thought, other than a smart, intelligent, nerdy guy like you guys and your team? So thanks for that.
Yeah.
To that note, one of the few states you've never done a cost segregation study on, considering there's 27,000 of these things on the books all over the country, is North Dakota. We have you coming out here to doing a couple. What would it be like for somebody that's in this area, that's looking to save money on taxes, that wants to explore a cost segregation study? How do they connect with you, and how do they get started to then add to the list of people when you come out and you can knock them all out in a efficient fashion?
Yes. Let me see here. So what we could do, and I'll bear with me one second. I'm trying to get a QR code.
And we'll put his link so that you can schedule a consultation. He'll run a free analysis for you. The last several that he's done for me on my personal buildings here have been nothing short of a miracle. And we'll connect you guys online, and there'll be plenty of links here as well.
Okay. So tell me, can you see this? Okay.
Yeah, you bet.
Okay. So that's the QR code. So this is our questionnaire. So all we need from your listeners, viewers, whatever they're called in podcast land, we just need basically these 10 questions. And most people in the real estate space are going to know those questions off the top of their head. This isn't like digging deep. Oh, I got to go dig up the plot plans and the deeds and the maps and all that stuff. It's stuff you know off the top of your head. The address, when you bought it, what you paid, that kind of thing. And the QR code will help us just be able to track if you wanted to get that. Ultimately, we'll then run the estimate for Erik's clients or Erik's viewers and provide a complimentary proposal on what the tax benefit would look like, number one. Number two, what the fee would be. And you can decide whether you think it's worthwhile doing. Again, going back to that conversation from before, most people look at it and say, hey, if I spend $1 and save 4 or 5, I'm going to be good to go with this. We hit that at 300 grand. And from what I understand, the median house price in the US is now north of 400 grand from what I hear. So, I'm going to go ahead and stop sharing. We'll run that quickly, and, you can make your clients, your listeners can make a decision if they think it's a viable thing for them. And I would love to do like 10 in Dakota.
Let's do it. Let's rally the North Dakotans out here. So for me, anybody looking to buy or sell a new property, but more specifically, a lot of you are stuck on the fence and it doesn't make sense to sell your current property because either A, maybe you owe more money on your loan, maybe you paid a higher amount for it, maybe you're worried about the tax implications of it. This will allow you to immediately save money on your taxes and make some of these deals that weren't penciling before pencil with our higher interest rates. And we're getting really good rents out here, especially on multifamily, single family, and industrial. So if you've been sitting on the fence, now is the time. Highly recommend Jeff. He's one of our vested and trusted partners. Would love to connect with you on a local basis here. But more importantly, you've got to have a plan. You've got to be strategic, and you really got to connect with guys like Jeff. So we could talk about this all day. I really appreciate you hopping on. I know you're a busy guy, and it took us a while to connect schedules here. Really looking forward to what we can do together. And more than anything, if you're an investor right now sitting on the fence, wondering what strategy you should take forward, please watch this episode, share it with somebody that you know that could benefit from it. Reach out to us over at Proven Realty, broker by EXP. Would love to connect with you. Would love to be able to strategize and come up with a game plan to help you save money and involve Jeff and his company to help you do that through a cost segregation study. So thanks for tuning in today. Appreciate you all. Hit the subscribe button on the way out, and looking forward to connecting with all of you in the future. Thanks for watching.